This is problem 23 from Chapter 2 of the CFA Institute textbook, Corporate Finance, A Practical Approach, 2nd edition. In this problem, you're given some information and asked to calculate the after-tax non-operating cash flows, which are often called the terminal cash flows. Those are the one-time expenses that occur at the end of a project when it's wrapping up. All right, so let's look what we got. The freighter company invested $38 million 5 years ago. And as they're wrapping this thing up, they're trying to figure out what the cash flow impact is. That $38 million was $30 million in fixed capital, fixed assets. They bought fixed assets. And $8 million in working capital. That's inventory and stuff. All right, today Freighters is selling the fixed asset for $21 million and liquidating the investment in working capital. That means that $8 million in working capital they're going to sell. All right, so sell the working capital, and that's going to be $8 million positive. There's no tax effect because those changes in the working capital aren't depreciated. They are actually expensed as we go along. And what happens is you have all that extra inventory in the final year. Rather than replace the inventory, you sell it. You just sell it and don't replace it. So the cost of goods sold subtracted from the revenue, taxes will be paid on it, but the working capital tends to be a non-depreciated asset. It's an expensed asset. Now that money that we sell the fixed capital or the fixed assets at, that's actually going to create a taxable event. I'm going to get $21 million from these assets, but unfortunately some of that's going to be taxed. The tax on it is based on the sale price minus the book value gives you the taxable gain. Okay, so if I sell it for $21,000 and I'm carried on the books at $15 million, that means that I've depreciated too much of it. And Uncle Sam comes back and charges me income taxes. What they're doing is recouping the income taxes that I saved by taking too much depreciation. So when I sell the fixed capital, the taxable gain, the tax on the gain would be at 40%. I'm going to owe $2,400,000. All right, and that's it. So the 5th year terminal cash flow, or the after-tax non-operating cash flow is what they're calling it, terminal value, would be the $8 million I get from selling off the working capital, the $21 million I get from somebody buying my crap from me, minus the taxes I owe on the gain. The taxes are based on having to recoup the underpayment of taxes because I took too much depreciation. So my after-tax cash flows come to $26,600,000.